Okay. Keith.
Let's just pause and take the closing bell here on Wall Street as we close out another unusual day in the markets here. Not as much selling, but an unusual day. So let's talk about where the major averages ended the day. The Dow actually doing the worst of the three major averages today, which is a little bit different than what we've been seeing recently, where the brunt of the selling has been borne by the NASDAQ. Right now, we've got the Dow down by about 350 points, off about 1%. As we spoke about, there were some misguided headlines earlier in the day that caused a brief spike in the Dow. But besides that, it has been the most consistently lower of the three major averages. The S&P 500 down about 0.25% when all was said and done, but it too flirted with positive a couple times. And the NASDAQ actually did manage to gain by the end of the day, with the tech names being the strongest performers as groups, even though there were some notable outliers. But overall, seeing tech perform the best today, even though it was just up 0.1%. Jared Blickery's got a closer look at the action today. Hey, Jared.
Thank you, Julie. Up, down, the name of the game has been volatility. The true range of the S&P 500, that's basically how much it fluctuated up and down, 8%. We haven't seen that in quite some time. You and I are going to do a postmortem in about 30 minutes, so I'll save the best for that conversation. But let's take a look at the VIX real quickly. So, settling down about 48.43. I like to look at the bond market VIX as well. This is going to be a year-to-date. That is at year-to-date highs, and we saw the 10-year T-note reverse upwards. The yield was up 17 basis points today. Here's an intraday. That is a lot to happen in the bond market. But let's get to some heat maps so we can get a visual idea of what's been going on today. And tech managed to end up 63 basis points, not quite up to the highs that we saw earlier this morning on that false news, but nevertheless impressive that we were able to find any green today. Communication services as well in the green. And then to the downside, real estate down 2.4%, materials, utilities, staples, consumer discretionary, all down 1% or more. And here's the final tally on the NASDAQ 100. Really mixed picture, especially with regard to the mega caps. You got Apple down 3.5%, Microsoft down half, Tesla down 2.5%, but Broadcom up 5%, Meta up 2%, NVIDIA up 3.5%. And so we're just seeing these big outsized movements here. And we also see this in the Dow to some degree. We were talking earlier, Home Depot down 3.5%, Travelers down 3.5%, but JP Morgan, which issued a little guidance this morning ahead of Friday, that was up 2%. And let's take a look at the transports as well. Kind of a mixed picture there. Uber up 1.5%, United in the green up almost 2%. For the most part, though, seeing a lot more red than green. FedEx and UPS each down more than 2%. And taking a look at some of our leaders here, we got stocks, we got chip stocks in the leadership position. Those were up 2.3%. And then to the downside, the biggest decline we saw was in Bitcoin, which plunged below 80,000. We'll also talk about that in a few minutes, Julie.
Yes, looking forward to that in the takeaways. Well, for more on the markets, let's welcome back in Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist. And of course, Kenny Quell-Carey is still with me for the full show. Keith, all of this said, what do we do as investors, right? And I was looking at some of your sector allocations, which I thought were pretty interesting. You still like utilities here. Utilities has been a group that's been was hot last year, tied to the AI trade. It has sold off some this year. What's your current thinking here on sort of the utilities dynamics in this environment?
Yeah, well, and I would probably put this in broader context. We have utilities as an overweight, we have communication services, and we have financials. And if you think about that, those are three different areas. Like one's a defensive, one's more of a growth and one's more of a cyclical. And if we're going to have this choppy market going back and forth, we're trying to find the best one of each sector. So, and I think if we have a little bit of a rally here, which I think we actually will on a short-term basis, utilities will likely underperform, but I think it will provide stability as we're thinking over the next, 3 months, 6 months. They don't have tariff exposure really. Solid dividend, about above 3%, trading at a discount, relative price trends somewhat positive. I also think what Jared just showed on the board, I do think some money will rotate back into tech short term. We are neutral tech, but we are overweight communication services. I was just looking this morning, the Mag 7 PE in July of last year was around 33, 34. Now it's down to about 22. That's the same level it was around October of 2022, right around ChatGPT came out. Now, there are some risk with earnings going forward, so I want to keep that in mind. But I think during this period, you will likely see now after these stocks have been hit a rotation back. So I would also look at communication services as well. And more broadly, Julie, you asked the question, what do you do here? I mean, first of all, we're telling our clients, if you have a lot of cash, it's going to be a bit of a bumpy ride, dollar cost average into the market. Also, if you're panicking, we don't think this is the right time to be selling after you're down 17%. As long as you can, stomach and you don't need the money, right now, we think there will at least be a balance to sell at higher levels.
Yeah, hey, Keith, let me ask you a quick question. As we come down into this week, we're going to get the FOMC minutes on Wednesday, which I don't think anyone's going to learn anything new that we don't already know. But Thursday, you're going to get CPI. Friday, you're going to get PPI. CPI is expected to be a tad bit weaker, and PPI is expected to be a tad bit stronger, right? Which is kind of interesting because that speaks right to inflation, which I think is going to end up being sticky this whole year. Tell me, what do you think?
Yeah, I just wonder how important those reports are going to be because at the backdrop right now, what are we seeing? We're seeing oil prices just plummet. We're seeing the 10-year Treasury before today come down quite a bit. So listen, if it was really hot, I guess it reinforces that the Fed's somewhat constrained. So an easier number would be better. I don't have a projection about what the numbers are going to be, but I think that the challenge that the market has and what happened on Friday was, Powell's basically, we're seeing weakening data around this, and Powell is still concerned about inflation. And I think maybe that can influence. But again, at the end of the day, don't forget, April 9th is a big tariff day. And I think those reports will matter. But what happens on the path of tariffs is going to be the main driver for this week, next week, and probably the next several weeks.
Right.
Yes, buckle up, or continue to stay buckled up, I guess, Keith. Thanks so much. It's great to see you as always.
Yeah, great to be with you guys. Thank you.
Let's check on a couple specific sectors now. We start with automakers, who are continuing their downward slide as the fallout from tariffs weigh on the sector. Yahoo Finance's Pras Subramanian joins us now with more. Pras, there's been a lot of ink spilled about what's going on and what all of this means for the automakers, and investors are still selling.
Yeah, we saw some of those names just there lower today. GM kind of popped back just a little bit, down only 1.5%. But they're heavily exposed to tariffs, unfortunately, because of auto parts, because of where the cars are made. It's just a lot going on there from a severe financial penalty point of view from the tariffs. And we had some news today on some companies like VW's Audi holding cars at port until they get more clarity. Jaguar, Land Rover halting all shipments from the UK to the US for now until they figure out what's going on. A research firm named Telemetry came out with some data saying that 1.8 million lost sales in the US this year from tariffs alone. We had about 15.8 million sales last year, so you can do the math. That's over 10% easily lost sales in the entire US auto industry. And finally, we saw Bernstein downgrade GM today, talking about hits to consumer confidence and also the tariffs also hitting sales. And that's a big whammy to their profits, but also, shareholder returns, right? Buyback's a big part of the GM story that may not happen if they're going to be using that money, deploying it elsewhere to kind of shore up their sales.
Thank you, Pras. Appreciate it. Let's turn now to oil. It's continued to slide as fears of cratering demand steepen losses from last week. Yahoo Finance's Ines Frey joining us here with more. Hi, Ines.
Hi, Julie. And we saw today that oil tumbled about 2%. But remember, last week we saw losses of 11% last week. So we're looking at right now WTI at around $61 per barrel, Brent crude hovering around $64 per barrel. Of course, the trade war, cratering demand fears, GDP forecasts, those are coming down. Also, over the weekend, you had Saudi Arabia that lowered the price of its flagship oil for its Asian buyers. So that also put pressure on oil. And that came after last week, OPEC Plus said that it was going to raise output in May, more than what the street had been expecting. So where do we go from here? Well, Goldman Sachs is saying that they have now lowered their price target for oil for WTI, expecting in 2025 WTI to be at $58 a barrel on average and Brent crude at $62 a barrel on average. Citi analysts are saying that they're seeing a floor, though, when it comes to these tumbling oil prices, because they're saying that OPEC Plus is not going to want Brent below $60 a barrel, and U.S. shale will not want Brent to or oil to go much lower. I do want to mention some other commodities, and that is that gold we saw today going below that $3,000 threshold. Gold had risen above that $3,000 threshold in mid-March, and it's made multiple highs over the year. So really pulling back a little bit when it comes to to the overall market. We had analysts that had been saying, if you see stocks coming down, there may be margin calls, traders will need to sell what they need to sell. But I do want to point out, over the last 6 days, just take a look at gold's performance, down 4% for over a 6-day span. But look, compared to other metals, silver much lower, copper also much lower. So gold really holding up when it comes to the metals, guys.
Ines, thank you very much. Appreciate it.
Thank you.
Stick around. Much more market domination overtime coming up. Morgan Stanley is downgrading some names in the banking sector ahead of bank earnings kicking off on Friday. Joining us for more, Yahoo Finance banking reporter David Hollerith. And the analyst behind this, Betsy Graysick, over at Morgan Stanley, is pretty widely followed. So what did she capture about sort of what people are buckling up for earnings season?
Well, so a lot of it is what we already have been tracking, the capital markets specifically, IPOs, bond issuance. It's all sort of on pause right now. And then if you just take in the recession factors or just the idea that a lot of people are talking about just the fact of slower growth for the rest of the year, they're adjusting their credit loss expectations up for the banks and kind of taking down revenue deal flow. So that's really what's going on here. And they moved from seeing the big banks or large cap banks as from attractive to in line. So they're not downgrading them to sell or anything like that, but they're definitely taking away a more optimistic view on these banks.
So I think, we're going to get earnings starting on Friday with JP Morgan and Citibank. The thing that I always like to look at, and we'll look at a lot this time around, is what they do with the loan loss reserves. Now, you already said they're going to start to raise that. Because what that tells me is it gives me a sense of what the CEOs at these banks are seeing and where they think maybe there's going to be some defaults, whether it's credit card defaults, mortgage defaults. Because if they raise their loan loss reserve account significantly, that to me suggests we're preparing.
Unfortunately, I think the only thing there is that we still might be too early for banks to be significantly raising their provisions for loan losses. That might be more like a Q2 thing. So we might really be paying attention to delinquencies. So
right.
Even still, like the consumer, for instance, we might not really have much info or details in terms of like what to expect. So.
And then there's an interesting view. Devin Ryan was on our air earlier this morning where he talked about maybe earnings won't even matter this time as much. Listen to what he said.
My view is earnings, I hate to say they don't matter, but right now we are in a macro market. Macro first, meaning what happens with tariffs and really the ultimate economy is what's going to drive sentiment in these stocks.
And to that point, to the sort of macro point, we got Jamie Dimon's letter this morning, the annual letter from JP Morgan, and he weighed in on some of those sort of bigger picture issues, as he tends to do.
Yeah, I mean, Dimon, he takes a very long view.
Yeah.
And we kind of saw a similar thing from Larry Fink, too, also today speaking at the Economic Club of New York. And, their take is it's going to be a lot more inflationary and painful in the short term. And at least Dimon was saying in the longer term, he hopes things will be good, but, we're not really getting much confidence from him that he thinks things will be or could be, but obviously he's known to be a worrier across Wall Street.
Yes, he is in his prior comments. All right, thanks, Dave. Really appreciate it. Well, Wall Street strategists are abandoning their bullish views on the U.S. stock market in droves as a sell-off in reaction to President Trump's reciprocal tariff announcements has experts rapidly paring their forecast for 2025. Joining us now, Yahoo Finance's Josh Schaefer. Not everyone is cutting their forecast, but we'll get to that in a moment.
Sure.
Because most of the strategists that you track are, and you have on yahoofinance.com a handy-dandy chart looking at the various forecasts and who's been cutting.
Yeah, Julie. So I guess I'll instead of going through all of the numbers of where they were and where they came down to, basically everyone was above 6,000 to start the year, and now you're starting to see a lot more people come down, right? So you have JP Morgan at a street low of 5,200, which I think is roughly where we closed today, somewhere around there. Sorry, no, a little bit lower today. But 5,200 for JP Morgan, Stifel's at 5,500, RBC Capital Markets now also around 5,500, Evercore down there, Goldman Sachs, Bank of America, Barclays, Oppenheimer, all of the names I just read are now below 6,000. And so really the broad takeaway here obviously being two key things, I think. One, When you have this big of a drawdown, just simply to argue that you can rally that high back up to a target that used to be 6,500, you're starting to call for a 30% rally in stocks out of here, which starts to just feel a little bit aggressive, I think, at some point. And then I think another key point that a lot of strategists are making is we're just not getting out of this that soon. And I think when you think about sort of how the trade war is playing out to this point, the escalation that you're seeing from some countries, thinking about the US and China right now, you haven't heard from other countries, you haven't heard about negotiations. And so I think it just makes the street in general feel a little bit less confident in calling for a massive rally in stocks when there's just so much uncertainty at this point.
Yeah, well, I mean, how closely do you watch these forecasts from these strategists?
I always like to watch them because I like to see, kind of where they start out and where they end out. Sometimes they don't really change much if nothing significant happens. But based on what we've seen over the last, couple of weeks, let's just say, but certainly the last 3 days, I can see where it's going to cause a lot of these estimates that were way in the 6,700, 6,500.
Some 7,000.
Yes, some close to 7,000. That it's just not going to get there, at least this year. And so they have to be realistic and pare it back. How far they pull it back would depend on, look, where did we close tonight? 5,100 or 5,000?
Little short of 5,100, yeah.
Right, so a 10% move up from there is going to take us to 5,500.
Right, yeah, so
right?
To get to those high numbers we were talking about, right, over a 6,000, one street analyst, Julie, that we follow closely, Brian Belsky over at BMO, he's still sitting on a 6,700 call. I mean, that's over a 30% rally from where we are right now.
Yeah, that might be difficult, but I'll tell you, if we get some really positive headlines, you know how it can happen.
Yep.
The same way they took them down, they can take them up 5%, 5%, 5% in 3 days. Same way they took them down.
You know what? Let me ask you something about this, Kenny, because you probably know. I saw something about this commentary over the weekend that some of the velocity that we saw in the declines had to do with market structure. In other words, the financial crisis, you did not necessarily, I mean, yes, you did see magnitude of huge declines, but now you have sort of an options overlay on top of the market. So what does that do to the regular market action?
Well, I think it adds more complexity to kind of the market action because you can hedge it so many ways. You can play 1 day options, 0 day options, 3 day. It's crazy what you can do. So it adds more chaos, I think, to the equation. But to the point, or at least from my perspective, after having spent 40 years on the floor of the New York Stock Exchange, and with the technology today, it's the speed at which the algorithms can make it happen that cause. And look, the sell algorithm, once the sell algorithms ignite, the buy algorithms understand that, and they just withdraw their bids and move down to lower prices. So there's this void in prices, and suddenly they just collapse. Well, the same thing's going to happen on the way up. If we get a couple of good headlines, and suddenly it looks like it's all positive, the sellers are going to be exhausted. They're going to go way higher, and the buyers are going to take it right back up again.
We saw maybe a sample of that action this morning. When the headline didn't end up being real, of course, but you saw the NASDAQ shoot up almost 4% in about 5 minutes.
In about 5, I think it was 5 minutes was the max, right?
Right.
And you see how quickly it can happen. And if that was true, then there would have been another positive headline on the back of that, and you could see how they could take it right back up.
And to sort of tie in what the bull case still is at this point, right? So I mentioned that 6,700 target from Belsky.
Yeah.
His point is exactly what you were just saying, Kenny. He said, I do not think Donald Trump is a president that would want a recession to happen under him and want the stock market to do this. At some point, he's going to step in, and when he steps in, it's going to be a big move.
Right. See, so I agree with Brian.
Yeah, exactly. And so I think that's sort of where people are teetering right now is at what point does he step in, and how low is the S&P 500 at that point if we are waiting for a Trump put?
Yeah, I think the S&P is finding its chi, right? It's finding its calmness right in here at that 4,800 level, like Keith said. I think that is a level, and that would still leave us, by the way, in a structural bull market even if we came down to 4,800. So, and I think people need to understand, and I do think that the retail investor is getting more used to this idea that we can have this erratic behavior and it's not really the end. I think there are certainly some people that remain nervous, but there are other people that say, I had a lot of clients that say, I want to put more money to work. I want to put more, and I was the one saying, not yet. Let's just slow down a minute. Yes, we're going to put more, but not yet. Let's just let this settle in.
Mm-hmm. All right, well, we'll see where that equilibrium, the chi.
We all got to find our chi.
That's right.
Of course, always.
All right, thanks, Josh. Appreciate it. Coming up as volatility sticks around, we're looking at ways to manage portfolios. Stick around, much more market domination still to come. The S&P 500 falling for a third day as tariffs send stocks on a volatile run. Yahoo Finance's Jared Bluckley joining us now with the trading day takeaways. It fell, the S&P fell today, but it avoided a key level.
Yes, the bull market is still breathing, and I've never been a big fan of the 20% strict definition. You got a couple cases in history that just missed it by a hair that, in my opinion, were bear markets. But this one doesn't feel like it just yet. We do have a different trading character in the market. This is the S&P 500. I'm going to go back 5 years here. I just want to show you that 2021 high, which was reached at the very, very end of 2021, very, very beginning of 2022. That's about 4,800, and that's kind of my line in the sand. So we got a little farther way to go. And by the way, intraday, we passed 49.15 to the downside, and then we got that nice little fake news bit and rocketed to the upside. That was 8%. But you think about all the markets that have already gone into bear market. We have the NASDAQ Composite, NASDAQ 100, Russell 2000, Dow Transports. Those are just the big ones. And then you have sectors, energy, materials, tech, consumer discretionary, real estate, and then you have bonds. The yields just shot up today. That was the worst day for bonds in months and months. So you put it all together, we're just experiencing a lot of volatility.
Yeah, speaking of which
comes to my second point here.
Yeah.
VIX has taken flight. So we were kind of breaking this down a few different times today, and I'll just show you the VIX real quickly so we can see. This is going to be closing prices only. I'll put 5 years so we can see the pandemic. And there you go. Here's the pandemic way back here, and I'm not even sure if I captured that. Let me put the 10-year on.
There it is.
There you go. So anyway, this high here, we have not breached that, but my point is the VIX has taken a long time to get to this level. We had that little blip in March, but that was at 2 weeks. A lot of times when the VIX doesn't mean anything, it goes up real fast, elevator up, elevator down. Not the case here. But I did have the opportunity to speak to Bob Lang on Stocks in Translation the other week, and he was talking about using protection and buying protection in the options market. Here's what he had to say.
I'm always a huge advocate for protection, protecting your portfolios, right? I mean, think of it as insurance, right? So, we all have health insurance. Some of us have life insurance. We drive cars, we have car insurance, fire insurance, everything, right? And why do we buy this insurance? We're not buying these pieces of insurance for a return, because we know that money is just going to be a sunk cost, right? But we buy that insurance to protect ourselves against a disaster happening, right?
So here's the bottom line. You should have bought insurance a while back. It's too late right now. You don't want to be buying the VIX at these levels. If anything, you would want to sell it, but I don't recommend that either. Bottom line, this is a tricky time. You need to buy the insurance ahead of time.
Yeah, but the VIX is a way of thinking about insurance, but you have to buy it before it goes boom.
Before it takes the elevator.
Yeah, before it takes the elevator. Let's talk about another asset class that we haven't talked about as much today, and that is crypto.
Yes.
And there we have seen, we're more used to seeing wild price action in the crypto market.
It's been muted.
Yeah.
Crypto has kind of been a store of value, a store of sanity over the last few days. Here's Bitcoin. It's down 1% today. When I say breakdown, maybe that's not even fair. Here's the year-to-date price action, and I just want to show you. It bounced off the 200-day moving average. That was right here, not shown on this chart. But then we just kind of meandered around. These were some very low volatile days. Meanwhile, the market was kind of crashing over some of those days. I won't talk about stock market crashing, but over the weekend, it just kind of slipped and it broke the support and we got all the way down to 75,000, 74 and change, and then we rocketed higher. That's a very important level because when I was talking about Bitcoin a few months ago, when I was talking about Bitcoin a few months ago, that was one of my big price areas. So I wanted to see it come down to 70 to 72,000. It got pretty close here, and there's some other technical considerations why I think 70.72 is good. Maybe that is already passed, but it's possible that Bitcoin is the not necessarily an inflation hedge, maybe it's just a Trump hedge. And so I'll just throw that out there.
Maybe it's, I don't know. We always talk about how it's not really correlated with anything consistently.
Consistently, it changes character seemingly every few weeks, every few months.
It does. All right, we'll keep watching it. Thank you, Jared. Appreciate it. Well, Trump's tariffs turmoil sending markets on a roller coaster ride again as volatility sticks around. We're looking at ways to manage portfolios with Edward Jones, senior investment strategist Mona Mahajan. Mona, it's always good to see you here. So as we know, people feel nervous right now. And we've been talking to people all day long and really over the past several weeks about how they can sort of protect themselves or navigate through this environment. What kind of calls are you getting from clients, and what is sort of the top message you're trying to send to them?
Yeah, look, this is a time of uncertainty and perhaps even peak uncertainty, given we don't know yet exactly what we'll go through on April 9th, this Wednesday, in terms of what tariffs will become effective or not. We don't know yet what countries will negotiate and which ones will retaliate. We're getting an early sense of that. But generally, markets don't like uncertainty, and that has certainly been reflected in the performance as well. As you noted earlier, the S&P 500 was on pace this morning for that 20% bear market decline. But what we're saying to clients is, look, when you look more broadly across asset classes, not just at the broader S&P or NASDAQ indexes, there are parts of the market that are holding up better. We're seeing that in bond performance. We're seeing that in international markets. We're seeing that even within the S&P 500, defensive sectors like healthcare, utilities, staples, all are actually higher year to date. So parts of the market have held up better. It really does come down to this theme of diversification in portfolios. And if you think about it, that theme didn't hold up as well over the last couple of years when Mag 7, mega cap tech really was the name of the game. Now that, if you've had that tried and true diversification strategy in place, you're finally seeing some of that downside protection come to bear.
Mona, it's Kenny Polcari. It's interesting because, to your point, while it may not have worked for the last couple of years, if you had it, you had it. So when you needed it, you actually had it. And that's the point that I've been saying to clients as a wealth manager myself, to the same point. People are nervous. I say, okay, let's look at the broader portfolio. Let's see, okay, your stocks are down, but your bonds are up, your alternatives are doing well, so there you have some stability. So you're not you're not getting crushed. Your portfolio is not down 20% at all because you've got the other parts of this portfolio.
Absolutely, and well said, by the way. I think that diversification message, maybe you were participating on the upside to some extent over the last couple of years, but really when folks see those negative returns, that's when those emotionally driven investment decisions really start coming to the forefront. And that's what we want to avoid. We always say, if you're trying to sell out of the market and buy back in, you have two decisions to make, when to sell and then when to buy. And investors are notoriously not great at timing either. The other point I'd make is bear markets do happen, and sometimes they happen even when we're not in a recession. What's interesting this time around is we're down close to 20% from the peak in the S&P. Markets may be starting to price a recession, but the hard data right now doesn't yet reflect that. In fact, the good news is we came into the year with pretty solid momentum in the U.S. economy. I think that is helpful. We saw a labor market that was still holding in there last week. We may start to see, some of that sentiment data that's showing up in the baskets start to show up in the hard data. But if we don't see a deeper, prolonged recessionary environment, perhaps markets are already reflecting some of that. So we've seen a lot get priced in over the last even several days, which is a good news for those that are looking more opportunistically, for those long-term investors that are looking to either rebalance, diversify, or just add quality investments at better prices.
Well, and I think there's a lot of places now where you can find that quality at lower prices and add to your current positions you don't necessarily want to get overweight, but you certainly can find opportunity to put some money to work. And on the other side, it's funny because last year it was bonds that were underperforming, right? They were down negative on the year, stocks were up. And this year now stocks are significantly down so far this year, but yet, the TLT and the TLH are both up, 6.5%. The ag is up about 3%. So to a lot of people that are wondering about, why they hold bonds, this is exactly why you hold bonds.
Absolutely. And, look, I think a lot of people and a lot of folks that may be closer to retirement or in retirement, they are hopefully well positioned for this as well. They have more fixed income type assets in their portfolios and are not seeing the same level of volatility. So that is a benefit of that fixed income, to your point. And look, a 10-year treasury, even here close to 4.25%, not a bad risk-free rate to lock in. So we are still, hopeful that bonds will continue to play that diversification role in balanced portfolios.
Mona, great to see you. Thank you so much for joining us.
Thank you, guys. Great to be here.
Going to get some breaking corporate news now. Broadcom's announced it's authorized a new share repurchase program. It's up to $10 billion of its common stock through December 31st. According to the company, repurchases under that new program may be made through a variety of methods. And so the shares are getting a little bit of pop here in the after hours. And this is, it's not only this share buyback authorization, it is also a message that it is sending to the market here.
Right.
That maybe things have fallen enough that they are now attractive.
All right, so what is, can you pull it up? I don't know what it's down on the year. What's Broadcom for the year? But I think that's exactly the point, right?
Yes.
Is that the company is coming out saying, this is a good use of our capital. We think our stock is now a value play. We're willing to commit our capital to it. And look what's happened in the after hours, right?
So here's what I'm going to tell you. It's year to date, it's down, but I'm going to tell you from its high, which was back in mid-December, like so many stocks were, it is down 38% from its high.
Think about that, 38%. So I agree. And this is where, just like we said to Mona, there are plenty of places to find very good quality stocks, and no one's going to argue about Broadcom, very good quality stocks that are now on sale.
Yes, and so do you think that we'll be having more companies like this that are coming out and making these sort of announcements potentially?
I think potentially going to see that during earnings season, right? Because that's usually when, if they're going to announce it, they'll announce it. I don't know how far, I don't know when Broadcom announces. I don't know if they're further down into the month, but I think you're going to start to see more, especially some of these names that have been really, really beaten up.
Yeah, most definitely. I actually want to take a look at some of the metrics that we look at on YahooFinance.com because I'm curious about the company's PE ratio, right? The backward PE, which is right here, I'm going to zoom into it a little bit, is 71. So that is still a relatively high PE ratio here. But you can also look at the forward PE and see that it is, it is a little bit more attractive. That is more like at 22 here. And so if you're an investor and you're trying to figure out, okay, I'm looking at this large cap tech stock, here's how much the stock is down. Here's what the PE is now versus where it was. You can see that 22 is down from where it was a year ago, closer to 25, if you're looking at the forward PE for a company like Broadcom.
Right. And so therefore it shows that, or it gives you a sense, if you're looking for places to put some money, places take advantage of stocks that are representing not only better prices, but value, that's what you're going to look at.
Yeah, exactly. All right. Well, coming up, President Trump's tariffs wreaking havoc on the consumer electronics industry. We'll be joined by an expert on the other side to discuss what is next for them. Stick around. More market domination overtime still to come. President Trump saying he will impose a 50% tariff on China. He said that earlier today in the White House. It's the latest move in his ongoing trade war with the country, and it has been wreaking havoc on the consumer electronics industry. For more, we're bringing Gary Shapiro, CEO of the Consumer Technology Association. Just to be clear, there already is supposed to be a 54% tariff that will be levied on Chinese goods as of Wednesday. This would then be an additional tariff on top of that if China continues to retaliate with a 34% tariff against U.S. goods. So given all of that, your members, what are they going to see in terms of increases in costs here?
Well, I'd like to start with the good news.
There's good news?
I'm that type of person. And the good news is that for the next few weeks, you're going to see a lot in sales of people who are going out and buying a lot of stuff. We're already hearing that from everybody. Obviously, it's a huge, huge cost increase. The tariff is a tax. And it's a tax that's borne by consumers and the producers. And they'll figure out their own pricing on it. But you can't get a near doubling of your costs and then just say, oh, everything's fine and dandy and consumers are going to have a great time. The thing is, the companies I've spoken to basically said, assuming the economy stays steady, which is a big assumption at this point, which may not be true, they'll probably still get the same amount of revenue, but a lot of it will be going, obviously their cost structure will go up. There'll be fewer people that will be able to buy at the low end of the market, people who are entry-level consumers, people who have less money. They'll be just locked out of the market and they won't buy. And then that'll affect, of course, and is already probably affecting employment levels, hourly workers, full-time employees, they just can't sustain, retailers can't sustain keeping them. And I think you're going to start, once we get past the sugar high of the next few weeks, when the inventories are low to nothing, or they cost a lot, you'll see some dramatic changes, I believe, in employment throughout not only our industry at retail, but every industry, whether it's apparel or footwear or so many others that rely on imports. I mean, the Americans have the best economy in the world, or we did until recently. And that's been sustained by the fact that we've done really well. So we've been able to buy a lot of stuff inexpensively abroad, created in factories that we'll never have here. That's not what we're good at. And it'll take a long time to even build the factories we should have here, like shipbuilding and shipbuilding, ships and ships. And so it's a very difficult situation now, not just for our industry, but for multiple industries and frankly for the American economy.
Right.
And that's reflected in the stock market.
So Gary, let me ask you a question. What do you think that China is going to come to the table?
I have no idea. I mean, I haven't been in China in a long time, but I know they're very proud people, and we can't, some of the views I've heard by people expressing, they're just copycats and they don't innovate and things like that. That's no longer true. Anyone who's been to China recently can see that they're investing in so many different ways, from their factories to the research and development centers. They're starting to become innovators. They're actually very strategic. They have millions of STEM graduates and engineers graduating every year, while we have more in the 100,000s. They have people who know how to build factories, and we have very limited knowledge in that area. And I think some of the companies, like what we've heard from like Apple, which will definitely invest in the U.S., but is also looking to India, some other companies, they're going to do what's right for their company globally. A lot of these are American companies. We're so fortunate we have so many of them here. But I'm concerned that these tariffs are taxes that will be inflationary. They'll cost consumers. They'll put us back. And at the same time, when we're cutting off relationships around the world,
right,
it's a very dangerous path we're on.
So, Gary, there was a report today in the Wall Street Journal that Apple was going to be trying to move some of its production of the iPhone to India from China, and therefore not eliminate the tariffs, because there are tariffs that are going to be imposed on India, but decrease the tariffs. Are you hearing from your members that that is what they are trying to do? Or is that a luxury that only the likes of a company with the resources of an Apple is going to be able to do?
It's interesting is our members, we cut this deal with China in the late 1990s that we would be good friends with them and we should manufacture there. That's what our government told us. So a lot of our companies went there. And then President Trump came and said, we really shouldn't be doing business with China. We should be going to other countries. So a lot of them invested heavily in Vietnam and Indonesia and the Philippines and Mexico. And now we're being told just a few years later, we didn't really mean that. We want you to invest everything in the United States. Well, you can't invest in the U.S. for multiple reasons. One of which is such an unpredictable political environment where things change every 4 years almost, and there's no consistent strategy or policy. But we have succeeded in focusing on innovation. So companies will do what's right for their companies and their shareholders and their consumers. And right now, the U.S. is proving to be a very, very untrustworthy ally. It's extremely dangerous for the world economy. The dollar is already weakening in just less than 1 week significantly. And we're telling our allies that we're no longer their friends. This is the worst economic situation I've ever seen in my lifetime. It's just not about any one industry. It's about our position in the world with going to a weak dollar. Soon we'll hear perhaps that countries are going to stop holding our debt. That means our taxpayers and our citizens are going to only be paying off interest on the debt. And as long as inflation is high, which tariffs will definitely do, then we'll have high inflation, high interest rates, and our economy and our recession is likely.
Gary, thank you for your time. Appreciate it.
Thank you.
We are watching some shares of insurers in after hours trading. United Health, Humana, CVS Health, they're all soaring. The U.S. government will be paying private Medicare Advantage plans more money next year than it had originally proposed. Those payments will rise by an average of roughly 5%. The Biden administration had proposed an increase of just over 2%, and that increase could generate more than $25 billion in additional revenue for the industry. The Centers for Medicare and Medicaid Services saying in a statement that the move is ensuring that Medicare Advantage continues to offer access to critical services here in an accountable manner, further strengthening the program's ability to serve beneficiaries. So again, these stocks are on the rise. Well, it's time now for our chart of the day. That's why you see Alexander Canal there. It's been an eventful day of trading with the S&P 500 finally falling into the red at the close. Yahoo Finance's Alexander Canal joining me now with a closer look in our chart of the day.
Yeah, Julie, eventful day to say the least. And it really all started this morning. Right around 10 a.m., the S&P 500 briefly swung over 8% in less than 30 minutes after confusion emerged over whether President Trump was considering a 90-day pause on his reciprocal tariff rollout. That's currently set for Wednesday. Now, the White House, they came out, they refuted the reports, and soon after, we did see stocks calm down. And we finished the trading day a bit more muted, especially compared to the past few sessions. Citi analyst Stuart Kaiser essentially described it as no signal, lots of noise, in a note to clients after the close. He said that at the edges, a noisy, flat day, especially after all of these tariff negotiation headlines, that's a positive. Now, others have said that this signals the market wants to rally, that any type of development or good news is going to be a positive for stocks, especially with the level of fear and volatility that we're currently dealing with. So overall, very wild swings today, but it does show us how this market is positioned and what we could potentially see in the days and weeks ahead. But certainly with such an intense intraday move, Julie, one of the strangest trading days that I think we've seen in quite a bit of time. But, you know, these days, I guess anything goes.
It feels that way, Allie. Yeah. Thank you very much. Appreciate it. Let's take a look at what's trending after hours. We want to talk about Levi's, the denim company. Those shares moving higher after it delivered a beat on first quarter earnings. The company is also maintaining its 2025 top and bottom line guidance, which excludes, it says, any impact from the recent tariff announcement. So that's really important here that I want to emphasize here. The company saying in its statement, Harmeet Singh, who is the chief financial and growth officer, says, we're maintaining our forecast, which seems like a good thing. But then they say, which excludes any impact from the recent tariff announcements, and we anticipate minimal impact to our second quarter margin outlook. Kenny Polcari, you are still with me here, and I've been looking very closely at companies like this because obviously Levi's sources a lot of its stuff from outside of the U.S. and is subject to tariffs. So you see a statement like this, and at first you say, oh, they're maintaining, that's a good thing. We're excluding all tariffs, though. Is that just because they can't quantify it at this time?
If they can't quantify it, but that then leaves open the door. While it sounds positive, they've just said we're excluding the tariffs, suggesting we can't quantify it, so we may have more negative news down the line.
It
but
feels that
the
way.
market is not taking it that way. I mean, it's up a little bit. What's it up? 2% in the after hours. Although it is down 34% in the last year.
Right.
So maybe there's a little bit of a push there, but it's going to be interesting to see if there's any other further clarification if someone starts calling them out, asking them for, for more clarification.
Well, I mean, the conference call is going to be real interesting in that regard. I am sure that analysts are going to push them on a potential tariff effect. But again, this is why earnings season is going to be so interesting, Kenny, because we're going to get these companies to say this. We're going to get forecasts for many of them, or
we won't get any.
We won't get any because they say we just don't know. What is the end? What is the tariff going to be? I have no idea.
And I think if you have a lot of them that say they're not going to forecast or they can't tell, that's going to be a negative, right? People are going to take that as a negative because they're going to lose. They're going to lose the guidance. They're not going to know which way to go. So that would, in my mind, it would cause the market to become weaker, or at least their stock to become weaker. But then if we keep hearing that with more and more companies, then it'll have a more broader effect.
Yes, exactly. We've been asking a lot of people today what they're expecting for earnings season. We didn't have a chance to ask you so much.
So I think earnings. Listen, I think when we came into the year, it was supposed to be 12% year-over-year growth. I think that's been whittled back down to 7%. We've seen, as they modify coming into the end of the quarter. So I think I'm comfortable saying that I think that's about what it's going to be. And to Keith's point, where he said you're going to see probably a 70% beat rate, which is kind of
it's a game
the number,
that they all
right?
play. Yes.
Right. So they lower their numbers and then they beat it. They go, oh look, we beat it. I get it, great. But it's really, again, it's not even so much about the numbers because remember the numbers are history. When they report their earnings,
About the
it's
future.
history. It is really about what they say going forward. And this quarter is going to be very important about what they say going forward.
Yes, it definitely is. All right, hang tight there. Time now for What to Watch. Tuesday, April 8th, starting off on the tariff front. President Trump threatening an additional 50% tariff on China in response to China's 34% retaliatory tariff. President Trump reiterating that tariff at a news conference with Israeli Prime Minister Benjamin Netanyahu earlier today. It's going to go into effect, as will most of the reciprocal tariffs, at midnight on Tuesday. This one, unless China rescinds its 34% tariff. Confused yet? Moving over to earnings. Some reports coming in throughout the day tomorrow from the likes of Tilray Brands and Cal-Maine. Tilray will announce results for the third quarter before the markets open. Analysts expect to see more profit growth in the quarter, driven by the company's recent beverage acquisitions and selling more expensive cannabis products. Moving over to the Fed, we'll be getting some Fed commentary in the morning from San Francisco Fed President Mary Daly. This coming after comments from Fed Chair Jay Powell last week. He said today that the central bank is in wait-and-see mode, but now bigger than expected tariffs could lead to lower growth and longer-lasting inflation. And finally, the NFIB Optimism Index coming out in the morning. Economists forecast March's number will drop to 99 on a month-over-month basis. That would make it the third consecutive drop and the lowest since the election. That new data will give us more insight into small business sentiment in the U.S. Well, that does it for today's Market Domination Overtime. Kenny Polcari, this was really fun.
Thank you for having me. I really enjoyed this.
Yeah, and by the way, this guy has a podcast, too, that you can check out. Trader Talk with Kenny Polcari. What is it, noon on?
Wednesday.
Wednesdays is
Noon
when
on
it drops, but you can listen to it anytime on your favorite podcast platform.
And I hope you do.
Thanks, Kenny. Be sure to come back tomorrow at 3 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night.